So I'd like to bring this afternoon session to order. Our first speaker will be Philip Hartman of the European Central Bank. Take it away.
Thank you very much, Huntley, and thank you to the organizers for inviting me to share some views about macro-prudential supervision. Probably one of the strong implications and lessons from the financial crisis is that the macro-prudential wing of financial stability and supervision has to be strengthened, and my whole talk will be dedicated to the question of what does that mean, how can we do it, what are the start of this in Europe, how that will be done, and what are the instruments and the mechanisms we have to identify the risks. You should keep in mind that I'm talking under the usual disclaimer, so everything I have to say are my own personal views and not necessarily are the views of the ECB or the Eurosystem. So the fundamental phenomenon underlying the concept and the phenomenon, the macro-prudential supervision is the phenomenon of systemic risk. So it is useful to start, when we think about macro-prudential supervision, about thinking about systemic risk, defining terms, and looking at the origins and forms systemic risk can take. The relevance of systemic risk was made crystal clear by the present crisis, and actually let me a bit anecdotically illustrate the problem some of us may have had before the crisis. So I compare two views about systemic risk before and after this crisis. The pre-crisis view is this little cite from the Swiss Journal of Economics by two authors who work on interbank contagion, who wrote that systemic risks are for financial market participants what Nessie, the monster of Loch Ness, is for the Scots, and not only for them. Everybody knows and is aware of the danger. Everyone can accurately describe the threat. Nessie, like systemic risk, is omnipresent, but nobody knows when and where it might strike. There is no proof that anyone has really encountered it, but there's no doubt that it exists. Okay, so far for the past. And the presence we all know, and you see actually the poor situation in which the scientists who thought along those lines found themselves. So you see here in the cartoon on your right of the chart, you see like the Lake Ness in Scotland. You see that's under the water, and there's a town of the monsters at the bottom, and there's this newsagent who is selling a newspaper and is giving the news that a scientist was seen on Loch Ness, and the scientist was looking above the water for the monsters and obviously couldn't see them. So I think a little bit that reminds some of us of the situation we found ourselves until maybe spring, early summer 2007. Okay, more seriously, let me give you a quick definition of systemic risk, which we find useful in the ECB to use. That's the short version of it. It can be defined as a risk that financial instability becomes so widespread that it impairs the functioning of the financial system to an extent that economic growth and welfare suffer materially. Now, important to emphasize is that systemic risk in this sense has to be, and the analysis of it for purposes of macro-prudential supervision has to be horizontal across the financial system. Since systemic risk defined in that form can involve in the transmission, the sources, and the effects, all types of intermediaries, markets, and infrastructures, the scope of macro-prudential supervision actually has to cover, to some extent, all markets, intermediaries, and infrastructures and be horizontal in that sense. But also, systemic risk has what one could call a vertical connotation, which is that very important is the two-way interrelationship with the economy at large, both in terms of the origins of the shocks that may lead to systemic events or instability, as well as the propagation and compounding effects that may build up over time in the transmission of instability. So today, I divide my talk in two parts. So the first part, which I just started, is about the problem, systemic risk and systemic instability. The second part will be about the answer, which I think should be macro-prudential supervision and regulation. I defined systemic risk for you. I will talk now in two slides in a very condensed way about the origins and the variants of systemic risk, which can be used like a little mini quasi-analytical framework that may be useful for policymakers to use to define macro-prudential policies. The answer to macro-prudential supervision, I will give also some definitions for you to make thinking more structured. Then I will have one part on risk identification tools. How can we identify systemic risks early? And then I have a part on policy instruments. What are the instruments that we can use to fight systemic risk? And then I will conclude. So 2 slides on a mini, decades of literature condensed in 2 slides, okay? So what are the ultimate sources of systemic risk? We should pay attention to design ex-ante policies against it. So on your left-hand side, you see these white arrows which list the market imperfections that may be present in financial systems. You will immediately see that incomplete markets, asymmetric information, externalities, public good character of systemic stability, public goods, multiple equilibria are phenomena that you find in almost every economic sector to some extent. So just focusing on these type of traditional market imperfections will not give us necessarily access to the right policies to stabilize the system. Now, what does that make financial systems special in making the effects of these instability, in these market imperfections worse? These are the 3 special features of financial systems in the red arrows at the top of the chart. The information intensity of financial contracts. They typically relate to promises of funds being paid or funds being dispersed and then have to be paid back in the future with all the uncertainties that go along with it in terms of uncertainties about reimbursement and the state of the debtors. Second, balance sheet structures of intermediaries, pronounced extent of leverage and maturity mismatch play a larger role in financial sectors than in other sectors, and the high degree of interconnectedness, in particular of wholesale financial transactions. So only if you combine the traditional market imperfections with these special features of financial systems, you get these powerful feedback and amplification mechanisms that we experienced so painfully in the present crisis. The nonlinearities and regime changes, my President Trichet likes to say phase transitions, but borrowed from physics. Now, of course, in terms of the market imperfection, information problems and externalities are sort of at the forefront, but you shouldn't forget that the others are also relevant. So in terms of designing policies, we need to have in mind that these imperfections, together with these special features of financial systems, need to be considered. Second slide on the framework. I like to, and we like to do, structure systemic risk in 3 main forms it can take. So basically these forms describe how a financial instability can become so widespread that it is actually a systemic problem. Now I've tried to illustrate that in this cube, which is a simple heuristic way of illustrating it, by characterizing these 3 forms of systemic risk with respect to their origins, their triggers, and the form of their impact they take. I can't go through all elements of this systemic risk cube. You will find it in our next financial stability review. But I still want to quickly dwell on the 3 forms, which are contagion, which is very well reflected in the literature, in the endogenous buildup and unraveling of imbalances, the red part in the picture, which may be described as the Minsky-Kindleberger type of systemic risk, and aggregate shocks that are severe enough, macroeconomic shocks that are severe enough to bring down a financial system simultaneously. The 2 forms of systemic risk that it is useful, I think, to make a very short comparison is the difference between contagion and the endogenous buildup and unraveling of widespread imbalances. So what is the difference here? Contagion refers to a phenomenon where a supposedly more idiosyncratic problem is amplified in the cross-sectional dimension, like the failure of a specific bank spilling over to other banks which looked healthy to start with. So the source of the widespread nature of the systemic event related to contagion is not common to start with. It looks idiosyncratic from the start with. That is a pure form of contagion. Now, the endogenous buildup and unraveling of imbalances is quite different from that. Let's take the example of the present crisis, the buildup phase. For certain incentive reasons in the financial sector and macroeconomic conditions, there was an increased investment in certain credit products, like structured finance instruments. And for these incentives and the conditions that prevailed in the macroeconomy, there was partly a type of herding behavior where many of the agents, or the systemically important agents, invested in these products. Now, this type of investment and use of these products for certain problems that existed became clearly excessive at some point, but still continued. And although it would have, from hindsight now, it seems clear that it was not sustainable, it went on for 2, 3, 4 years, and the imbalance became more and more widespread. Now, however, it didn't lead immediately to instability. These type of assets sat on the balance sheet and off balance sheets of many intermediaries across the system. So necessary was a repricing of risk with respect to these type of instruments to make these imbalances that were present already for some time in the system to break out together. Now, why do I explain, and that creating a systemic crisis in a simultaneous way? This can be easily confounded with contagion. Now, why do I dwell on it so much is because I'm not arguing that there was no contagion present in the present crisis. There was contagion present, but we need to distinguish that because the ex-ante policies to tackle contagion and tackle the endogenous buildup and unraveling of imbalances may be different. And also the identification tools we have to use for both may be different. And therefore, I was trying to dwell a little bit on that. So I come to part 2 of my presentation. What is the answer? So the broad policy response should be the strengthening of macro-prudential wing of supervision and regulation. Now this, many of you may know, this notion of macro-prudential policy dates back, was seen for the first time in official reports in the mid-1980s, for example, in the so-called Cross Report, which was a report by the Euro Currency Standing Committee, chaired by the then president of the Federal Reserve Bank of New York. Interestingly enough, a report on innovation in international banking, believe it or not. So 25 years ago, people thought that a source of need of macro-prudential policy was actually related to this. And if you remember what I just said about structured finance investments, that sort of should ring a bell now. Then there was the path-breaking speech by Andrew Crockett, then general manager of the BIS, about marrying the macro-prudential and micro-prudential approach to financial stability. So there was awareness of the need for this approach, but let's face it, it didn't really develop decisively enough in order to make a difference in the run-up for the present crisis. What do we mean by macro-prudential supervision? Public oversight that aims at identifying and containing systemic risks. Macro-prudential regulation, public regulations that aim at maintaining systemic stability. Now, if you look at the European draft legislation to prepare for the reform of the financial architecture in Europe with respect, for example, to macro-prudential supervision, you will find actually in the mandate, in the draft mandate of the new bodies to be created for the macro-prudential side, a mandate that is actually focused on systemic risk, on containing systemic risk. It's actually written in the draft legislation. You find the word systemic risk in the draft regulation. Now, I will come also to it later. Macro-prudential regulation actually, if it was fully developed, actually has the potential, one could argue, to join monetary policy, fiscal policy as a quasi-third macroeconomic stabilization policy. And I will come to that when I talk about the interaction between different policies. Typically, this type of policy has been more the realm of central banks than of traditional micro-prudential supervisory authorities for the reasons of the experience of central banks, for example, in macroeconomic analysis and system issues, and its experience also in stability issues with respect to crisis management. Now, one lesson of the present crisis was also that purely micro-prudential supervision is probably not sufficient, since it looks at intermediaries and markets in an isolated way. Now, it is hard to distinguish macro-prudential and micro-prudential supervision fully, and actually the two forms of supervision should actually interact. They are closely related, and I will dwell on that a little bit later, but the one important distinction is the objective that they aim at in terms of stabilization, whereas the macro-prudential aims at the system, the micro-prudential at individual intermediaries and markets, and this is an important addition to the supervisory setup. Let me briefly dwell on the objective of macro-prudential supervision. Now, an important challenge we face is that if you compare macro-prudential policies to, for example, monetary policy, is that in terms of the metric we can use to measure the target, it's way more complicated. We don't have clear metrics that we can use to target systemic stability. It's a multifaceted phenomenon, and it's no way comparable, for example, to using an inflation indicator, in inflation rate, like in the case of monetary policy. Second, prudential policy, it focuses on an ex-ante perspective. So I will only take in this talk the ex-ante perspective. I will not talk about crisis, or hardly talk about crisis management. I just want to mention it because, of course, crisis management policies and ex-ante preventive policies in the end interact, but I will not dwell very much on the interaction today. Still, macroprudential policy is, from that angle, asymmetric because it focuses really on the preventive mode, on the ex-ante policy. So the Bank of England, in a recent very interesting discussion paper, has put forward another formulation of objective of macroprudential policies, which reads like it's on the slide here. The goal of financial stability should be stable provision of financial intermediation services to the wider economy, payment services, credit intermediation, insurance, and insurance risk. This is a more symmetric objective, and therefore, in that regard, more ambitious definition of an objective from a macroprudential supervisor. I'm glad to see that when I put up this chart, usually in front of a US audience, I get some laughter in the audience. So it's actually my second talk in Canada, so I'm delighted that this is not the effect here. Okay, now we can. You have a lag. Okay, so this looks complicated, but it mainly looks complicated because I put so many things in one chart. So I've tried to here. If you take the current legislative proposals, the current legislative draft texts that are discussed, and you try to put them for the architecture reform in terms of the setup of institutions for the European Union, if you put everything in one slide, that's my goal in doing this, to how it would look in my view. So we distinguish there are two wings of the supervisory setup. The upper part is the European Systemic Risk Board, it's the macroprudential wing, and the lower part is the European System of Financial Supervisors, which is the microprudential wing. The bottom part, starting with the bottom part, the microprudential part basically would strengthen the role of 3 European supervisory authorities, which are the 3 authorities on the top. I can't point there, actually. I'm always trying. A European Banking Authority, European Insurance Authority, and a European Markets Authority. Now, these authorities would be closely related to the respective national supervisory authorities for banking, insurance, and securities. It is, relative to the macroprudential body, I will talk about in a second, a more, quote-unquote, more decentralized system, although it lifts more powers to the federal level compared to before. Actually, the 3 European supervisory authorities would be successors of what we called the level 3 Lamfalussy committees before, so which were committees that had a coordinating role, and now these authorities are supposed to have a more wide-ranging competencies at the federal level. Now, this macroprudential body will be represented, as I show you, in the macroprudential body to some extent, and have the role to provide all the macroprudential information to the macroprudential body. But more interestingly for my talk today is the upper part of the picture, which is the European Systemic Risk Board. And basically, in terms of membership, it will contain the 27 central bank governors of the EU, plus the president of the ECB, the 3 chairs of the new European supervisory authorities, plus the European Commission. The rest are observers, are not voting members according to the current proposals. These have not passed. They are in the legislative process. Now, another important aspect of this setup is that the ECB would be assigned the role to support the ESRB analytically, logistically, statistically, and in terms of administration. So this is the institutional setup. More important is what will these bodies, in particular the macroprudential body, do. So it will have 2 main tasks, which are illustrated in the little bubble, the circle on the right. First, to issue early risk warnings, either to relevant authorities or publicly, about emerging systemic risks. Second, to give policy recommendations how these risks, these emerging risks, can be addressed. Then these type of, which also can be either addressed to the authorities or made public by certain procedures. Now, the recommendations and the risk warnings can go to the variety of bodies. They could go to the European banking supervisors, go to the national supervisors, to countries, or to European bodies. These are things that are currently hammered out in the legislative debate, how exactly that channel would be. This is the institutional architecture that is currently on the agenda. I first come now to identification, systemic risk identification by such a body, and in the second part I will go to the policy instrument for macro-prudential topics. There's a lot of things going on here these days. So let me start with identification. Okay, so identification. So of course identification has a range of obvious things that are relevant for any supervisory authority, but let me point in these 4 elements on a few examples I think which are important. Not a comprehensive list, but just a few points that I think are important as lessons from the present crisis. So the 4 elements are, of course, a very widespread market intelligence, actually cutting across all the sectors horizontally of the financial system, very important, not leaving out any pockets about which we have no knowledge in the terms of surveillance and monitoring and understanding what's happening. The data and statistics, which can be read directly. Certain analytical tools and models that we can use to filter the information we get and to make quantitative assessments. And, of course, a lot of experience and judgment in financial stability matters. Let me start with market intelligence. The one thing I would like to emphasize, is, for example, is market intelligence has to be enhanced with respect to the understanding and role and risks of certain financial innovations. This doesn't mean to regulate away innovation in the financial sector. But first of all, we have a limited understanding of the cost and benefits of new innovations on the one hand. Actually, it's amazing how little documented are the costs and benefits of the major financial innovations in the past in the literature. Really, for the supervisory authorities, have a clear grasp about what risks can be taken, actually how the market is using these instruments. So I do think that a macro-prudential supervisor have to have clear view on the systemic importance of the major financial innovations. And that is, I think, a lesson from the present crisis. Data and statistics, I pinpoint again only to one point, which is important to me, is a macro-prudential body has to have good access to microdata about positions, assets, liabilities, off-balance sheet positions, and bilateral exposures among major financial intermediaries for the standard banking system, but also for other parts of the financial system. Again, not to regulate every sector of the financial system, no, to understand where the risks migrate and what type of risk behavior is actually taking place, and not have black boxes where the understanding of risk accumulation is really limited. Let me come to the analytical tools and models. I've listed them in 4 bullet points. There's, of course, tools to identify systemic crisis. I will show you one in the next slide, which we have recently developed in the ECB. Then I go through the 3 forms of systemic risk. I find it useful to organize risk detection and policy instruments along the 3 dimensions of systemic risk I was describing before. The 3 dimensions, remember, were contagion, the endogenous buildup and unraveling of widespread imbalances, and the aggregate shocks. So we have contagion spillover models to detect contagion, for example, counterfactual simulations with balance sheet data, SIG, the data point I made before. And we have, for example, flow of fund analysis to bring the spillover analysis across different financial sectors and maybe even to the real economy at a more aggregate level. Second, imbalances, particularly geared towards the identification of imbalances, are so-called early warning signal models. Recently emphasized have been particularly models based on indicators like credit to GDP gap and leverage. I will show you one example in the next, in the one slide after, and forward-looking financial stability indicators. And last, we have the aggregate adverse scenarios. For that, we have macro stress testing models, which assume extreme but still plausible macroeconomic outcomes and look what impact they would have on the financial system. So with that type of analysis, you could assess the resilience of the financial system to a range of extreme but still plausible macroeconomic shocks. Let me move to Of course, all these measures and tools have their assumptions, their problems, so you have a range, need a range of tools along those lines, but a body that has actually responsibility and accountability with respect to the tasks I was describing before will have to use some of them, or even a wide range of them. Just one indicator of systemic stress. This is not a forward-looking, this is a coincident indicator. We have recently developed, I named it the KISS. The KISS, you need some continental European pronunciation to have it instead of a CIS, but I find KISS much more sympathetic. So what you see here is over 10 years the KISS is plotted. Basically this indicator, what it does, it's pretty empiricistic. There's no or little theory behind it. It just takes the major parts of the financial system, equity, bond, money, foreign exchange markets, and intermediaries, developed part on intermediaries in there, which is an innovation in that type of indicator. For each of them, you have a bunch of sub-measures like volatility measures, spread measures, cumulative price declines, and even data like recourse to marginal lending for the intermediaries of central banks. You aggregate them for each subcomponent, and then you basically weight the subcomponents by the correlation between the two. So by using the dependence between these 5 subcomponents, you basically emphasize systemic problems relative to other problems that have no systemic connotation, where there's actually these 4 components are acting separately. Moreover, the weight of the 5 components is determined by their relationship to the real economy. We run simple vector regressions to assess like which of these market segments are closer to effects on the real economy and which are less close to effects on the real economy, and we weight the 5 components accordingly. For example, the intermediary sector, the 5th part, actually has the biggest weight because empirically it tends to have, for the euro area in this case, the biggest relationship to industrial production. Now what you see, of course, here is that at least if you take the last 10 years, then the crisis between 2007 and 2010 was unprecedented. First of all, already in August 2007, this type of measure would show you more systemic stress than for any other episode in the 10 years before. And then for September 2008, it would approach even the maximum value of 1 of extreme systemic stress, where all components of this indicator would be at their maximum level at the same time. Which is, I think, the phase transition Monsieur Trichet likes to talk about in this type of context. So this is one type of indicator which could be like a warning signal about the current state of stability. Now, you need many more ingredients and their assumptions and so on, but that is one tool that might be useful to look at in addition to other things. I've seen many of the Bank of Canada has developed such an indicator earlier, a little bit different. I have seen Federal Reserve Board presenting a similar indicator, Diana Hancock. So it's useful to have such a thing in the back, to have a quantification of the degree of systemic stress. My second example of detection tools is early warning indicators. Now with this chart, this is just one example of some research on a specific early warning indicator. This indicator basically looks at stock markets and property markets together, so it doesn't separate them out in this particular case. And basically the blue line is the detrended private to credit GDP ratio as an early warning signal measure. The gray parts in the picture at the end of the 80s, at the end of the 90s, and now more recently are phases of asset price misalignments for these 2 types of market segments that were associated with 3-year or longer GDP performance below potential of at least 3 percentage points. So these are costly asset price misalignments by the definition of misalignment that is used here. The red dashed line is an optimally derived signal threshold. So if the indicator moves above that dashed red line, the blue line moves above, then this indicator would give a signal of a costly asset price misalignment building up in those markets. One that is typically was in history associated with this growth underperformance afterwards. Now you see that this type of indicator, this one, gave a signal before every of these 3 episodes that we have here in the sample. At the same time, however, you see also the issues that surround these type of early warning indicators, because sometimes the warning is very early, very, very early, and no misalignment is already there. Sometimes they only start shortly before the misalignment. Sometimes, like in like 86, 85, a signal is given and no costly asset bubble was building up. And I will come to that problem when I talk about the communication issues with respect to early warnings. So basically, so this is one early warning type of indicators, and I choose that one because the credit to GDP ratio has recently received a lot of attention. There's also other research from other institutions like the BIS using different metrics, finding that credit to GDP ratios are an important early warning signal measure. Now, how to deal with this one task of the European Systemic Risk Board, the early risk warnings? It's hard to predict crisis. Typically, these type of measures have predicted crisis in the sample, but the next crisis was rarely predicted. So one has to see whether this has really changed. The intermediate goal of the warnings alone, not talking yet about the instruments, is that they may change market behavior. So if you identify and you communicate clearly about them, some markets may correct their behavior if they are clear enough. And second, they may encourage in itself already corrective policies by the competent authorities who have instruments in their hands to change this type of behavior. In the best of all worlds, the warnings would already have this type of effect. One lesson from the present crisis is that the warnings that were undoubtedly there in a number of outlets, in speeches, in financial stability reviews, in the BIS annual report, were way not loud enough, not strong enough to have these 2 effects on these 2 intermediate goals. What are the challenges of public warnings? Well, as I illustrated with the early warning indicator, which is the quantitative aspect of it, the scope for type 1 and type 2 errors. So if you have too many false warnings, you endanger the credibility for the next time. People will not believe you any longer. If you miss crisis, so you don't warn so often, you rather miss sometimes, then you don't fulfill your mandate. All this will impinge on your effectiveness of your policies in such a body. So the bottom line is the communication with respect to early risk warnings will be an art, although science should be an input into it. Let me come to the instruments. Macro-Prudential policy instruments. I again organized a list of instruments along the 3 forms of systemic risk: the contagion, the imbalances, and the aggregate shocks. Now, these instruments that I'm listing here, I try to put them where they are most effective or most geared to. It doesn't mean that they could not also be used for other purposes, but I try to organize them along those lines. This is not a comprehensive list. So I thought I picked instruments that are particularly important in my view, but the list could be much longer, and there exists works among the competent authorities, obviously, on these things. Some of the examples I'm giving are currently seriously discussed or proposed for measures in response to the crisis to improve the resilience of the system in the future. Others are not yet so close to the actual implementation in terms of policy. Also, what you see when you go through this list is that many of these measures, many, although not all, but many, are really instruments that presently are close to the Macro-Prudential supervisory authorities. Most of them are actually instruments that have been used for Macro-Prudential purposes in the Macro-Prudential supervisory authorities, which creates an issue that I will address later, which is the question also of some coordination and actually the effective use of instruments across different authorities. So here, a quick run-through. Contagion risks. Basel Committee has proposed enhanced capital for counterparty exposures, something in the current proposals. Introduce a capital surcharge for systemic risk that individual intermediaries actually have for the system. Currently seriously discussed at the level of the Financial Stability Board. And third, in some countries seriously discussed, although not in all, potential levies for systemic risk on banks, which is a type of PQ taxation of the quote-unquote pollution, systemic risk pollution that certain intermediaries can impose on the system. Often the levies are combined actually with a pool of funds to stabilize, but as I explained before, I will not so much focus on the ex post dimension. I will focus here mainly on the ex ante dimension. So these are 3 measures in direction of limiting contagion risk. Introduce procedures for orderly resolution, relevant for contagion, but also for the buildup of imbalances, very important. Crucial element of the package in the US, including living wills, like the rules that could ensure, if effective, a smooth death of large and complex intermediaries. Move of derivative tradings to central clearing counterparties, seriously considered and actually very close to adoption in various respects at the policy front, is an element that could contain contagion risks in those markets. Prevent the buildup of widespread imbalances. Of course, there are the counter-cyclical capital requirements or forward-looking provisioning, like dynamic provisioning. Limits on leverage and maturity mismatches in financial intermediaries. Balanced accounting approaches, having fair value accounting where you have clear market prices, where you have liquid markets, and maybe have some inroads of different approaches where you don't have clear prices and you don't have liquid markets. Influencing compensation practices to move incentives for risk-taking and herding behavior in the financial industry, also underway in many countries. Then working more on the demand side of credit, loan-to-value ratios, debt-to-income caps where appropriate. For example, where changes in loan-to-value ratios where, for example, property bubbles are building up in certain countries, for example, could be used and influence the demand of credit, of course. Actually, it is interesting to observe, as many people in the room know, is that actually some emerging markets have more experience with macro-prudential policy instruments than industrial countries. For example, if you think about the building up of imbalance, if you have a small open economy and the risk of capital inflows, if you require capital inflows to deposit a certain amount of money at the central bank or the treasury and thereby limiting excessive inflows, it is kind of a macro-prudential protection mechanism for your country. So that one could, for example, add such a potential measure in this list of preventing the buildup of imbalances. Third form of systemic risk, the aggregate shocks. Of course, high capital, high liquidity requirements based on stress tests would be a measure. Potentially the additional contingent capital on top of the regular capital, contingent capital cushion, so that certain debt instruments would convert into equity, so that basically the equity hasn't to be there in the regular times, but only in the stress times, and therefore enhancing potentially efficiency is seriously considered by the competent bodies at this point in time, and also experiences of emerging markets, again, say with, for example, the buildup of a war chest of foreign exchange reserves. So this is just a laundry list of examples of instruments, and what you see from that is that a large part of them actually is currently in the hand, not all, but a large part in the hand of macro-prudential supervisors, which raises this issue of the interaction between the macro-prudential and a micro-prudential supervisor, for example. What are the challenges with respect to policy? Well, while the transmission channels at the level of individual markets or intermediaries are pretty well understood, I think at the system level, they're not way as well understood as they are at the individual level. Calibration of individual instruments is difficult and even more complicated by the interaction of different instruments. So basically, if you think about the range of proposals that are currently discussed at the international and national levels, there's a serious issue of calibrating one with respect to the other. Say, think surcharges, counterparty risk capital, and so on, levies, they need to be coordinated in some way, and given some limits on the knowledge about the transmission channels pose challenges here. Then, very important challenge, a level playing field across financial subsectors, so that the regulatory and supervisory setup doesn't provide incentive for evasive behavior, for regulatory arbitrage. This is a key element of what I really think macro-prudential supervision needs to achieve. There can't be an imbalance where the regulatory system, actually, on supervisory system, actually imposes on or provides to the system incentives to move the risks to some part that is not supervised or not regulated. So there needs to be a balanced hand to balance these things out. At least we have to understand all parts of the system. And then last challenge, the effects on the overall economy. If we want to make impact studies to balance stability considerations with growth considerations, we need these assessments of the real economy. And let's face it, on the quantitative side, we have not so good tools right now to make quantitative assessments of that. Policies, you have seen the European setup. There's a micro-prudential, there's a macro-prudential. You see that many instruments may not be in the hands of a potential macro-prudential supervisor. How can you make sure that timely action is taken? Well, the challenges are, as many people have said, it's difficult to take away the punch bowl when things go well. In the upturn, it's hard for supervisors actually to constrain the activity, the risky activity. Second challenge, as I said, macro-prudential bodies may not have, actually not all of them, some may, others not, have directly the instruments to fight the buildup of risks that they actually identified. What are the potential answers? Well, there's a discussion with respect to the first point on rules versus discretion, so a mixture of pillar 1, pillar type 2 of activities, like more rule-based activities and more discretionary activities. Maybe an approach of constrained discretion is appropriate as well. A second element to deal with point 1, for example, is political independence. Now, in the European setup, for example, the Systemic Risk Board, will the larger part of the membership will actually be from the central bank community, which has a relatively strong and pronounced political independence, and that may help in this regard maybe to be more forceful on warnings, for example. On the second part, that the macro-prudential body may not have all the instruments at its own disposal. In Europe, that would be the case if these things are adopted that I showed to you. Then a rule of comply or explain could be enacted, and the possibility of scrutiny through accountability to competent parliamentary committees, for example, and potentially the publication of recommendations could help to enforce that actually timely action is taken. Actually, the Systemic Risk Board would also have the task to examine, if it's introduced in the way it's currently proposed, to examine the follow-up by the competent authorities with respect to the recommendation it makes, both in terms of the effect of things that have been introduced upon the recommendations and things that may not have introduced, and how the situation evolves. Interaction with other policies. As I said, if you would be able to fully develop macro-prudential regulation, it would quasi-join monetary policy and fiscal policy almost like a full third aggregate macroeconomic stabilization policy, which raises the issue of coordination. Let me quickly make a few comments on monetary policy. So one advantage of fully developing a macro-prudential approach to supervision and regulation is that some pressure is taken off from monetary policy to lean against the wind. Actually, some of the wind to lean against may be taken away. And actually, Don mentioned it in his presentation. I think this could be an important role of a macro-prudential body to assume. I want to point you to one paper, actually, who looks at this interaction, a very early paper. It's very complicated, very difficult to read, but it addresses exactly this issue. How does monetary policy and macro-prudential policy relate to each other? It's by Ignazio Angeloni and Esther Faya. And they basically find, using a standard dynamic stochastic general equilibrium model combined with a Diamond-Rajan type of financial instability model, that according to their research, the following combination of monetary and prudential policies would be optimal: a monetary policy that puts a strong emphasis on price stability, at the same time exerts some leaning against asset bubbles and or leverage, and a counter-cyclical capital requirements. There's another challenge. The macro-prudential policy needs to be differentiated from monetary policy implementation. There are some elements in the tools that we have in the toolkit for liquidity management that can be used for macro-prudential policies, but since they are so closely related to monetary policy as such, a setting of monetary policy, they need to be considered in that realm and not in the macro-prudential realm as such, but still some coordination and calibration is necessary. Interaction between macro-prudential and fiscal. Well, we painfully experienced that fiscal policy can be a relevant systemic risk factor recently. So it has to be considered whether the current fiscal situation can contribute to systemic risks. Other issues, for example, the question of the alignment of corporate taxation with potential bank levies against systemic risk. Whether tax treatments of interest rates or loan losses, for example, can actually be fostering financial bubbles. All these things should be considered in the coordination between fiscal and macro-prudential policies. Then there are other policies than fiscal or monetary. For example, very important, social policies could have a bearing. For example, social policies fostering home ownership, for example, could be a factor in helping the demand for credit, and thereby needs to be considered in the coordination between this and the macro-prudential supervisory policy. I'm at the end. My conclusion is economic and the crisis has shown the devastating effects of systemic risk. The macro-prudential approach to supervision and regulation is, in my view, a fully developed and adequate broad policy response. But important challenges remain. It's difficult to identify early systemic risks, and there may be some challenges in fully calibrating the effectiveness of regulatory measures for macro-prudential purposes and to assess the costs of regulatory measures. And that leads some to favor a more ex-post insurance-related policy with respect to systemic risk than an ex-ante-oriented prudential policy with respect to systemic risk. My conclusion is we need to invest in collecting all the data and in enhancing our understanding of systemic risk and how to fight it. Fully developed macro-prudential supervision and regulation can make a difference, although we have to make sure that expectations are also realistic with respect to it. Thank you very much.
Thank you. That's a very interesting paper that we've just heard, and really setting, I believe, setting the work plan for central banks and bankers and for regulators for many years to come. Don was saying this morning that it took us 30 years to get inflation down, to develop a framework. I hope it won't take that long to develop a framework for financial stability, but I think that we have here pretty much all of the elements. In fact, all of the elements that David was mentioning this morning in terms of what makes a complete framework have been touched upon in this presentation. But clearly, what comes out of it is much more the fact that we're only at the beginning. We feel, as the conclusion said, that developed macro-prudential supervision can make a difference, but there's still a lot of unknown about we don't necessarily know what the tools are. A lot of them are untested. So expectations really do need to remain realistic. And as we develop the framework, I think we'll probably proceed little by little. But I think that most of the elements are in this presentation. So the presenter started with a definition of systemic risk. And I think risk is appropriately defined. Systemic risk is defined as being so widespread that it impairs the functioning of the financial system to the point of hurting the real economy. I think that's right. One thing that I felt was not right is to compare systemic risk with NESI, however. With NESI, we've seen a lot of unconfirmed sightings, but we haven't seen much damage that NESI has wrecked. With systemic risk, maybe it is unseen, but we certainly have felt the damage many times. And with the nature of systemic risk and what makes it important and worth examining is that it is an endogenous outcome of collective behavior. It's not an exogenous phenomenon like some of the risks that we think about, but it really is endogenous. It arises, of course, from contagion, the fact that the financial system is an intricate web of claims and liabilities. So there is contagion from counterparty exposure. There is contagion from common exposure. In fact, one source of vulnerability in a financial system is arising from common exposure is the kind of the herd instinct that we see, that we all know that diversification of portfolio is good, but you may have diversification without necessarily having diversity for the system as a whole, which can create systemic risk. And there is the amplification of shocks that arise from common responses. One such common response is indeed the pressure to jump on bandwagons in good times, or the pressure to sell in distressed market in bad time, the rush to the exit, and clearly that amplifies the risk. And very clearly, in the context of the financial sector, where there is a safety net, the moral hazard is certainly itself a source of systemic risk. Thank you. So we go to the identification, and one of the things that's mentioned is that the warning signs tend to get ignored. Crises are difficult to predict. In fact, the warning signs are always evident in retrospect. There are some common features of any crisis, and one is excessive leverage. There's also a kind of excessive optimism. There's always this view that this time it's different. There's always a good reason, good rationale for thinking that this time is different. And of course, that's also true from the point of view of the supervisors. There's a kind of intellectual capture that is very difficult to resist here. What makes the crisis difficult to predict, of course, is in a sense it's the timing and what will be the character or the nature itself of the crisis. And part of that in terms of timing is as a result of the multiple equilibrium issue, the fact that there are sudden shift in sentiment that are very unpredictable. What will cause it? What will trigger the shift in sentiment? And it's almost part of human nature. So there is optimism until you start to worry. But when exactly people will start to worry, and when they will start to worry, when will the worry be generalized enough that it turns into a crisis is always very difficult to predict. What is not so and the liquidity freezes that can come out of it. What is not so difficult to predict, of course, is the buildup of imbalances. So when we look at what we can do to identify the risk or the vulnerability, well, we certainly want to focus on leverage, the pricing of risk, and in the context of the last crisis, central banks had been talking very much about the fact that they worried about the fact that risks seemed to be mispriced or priced very, very low. Risk premiums were extremely low. But having identified that, what you do about it is a very different question. You can identify the buildup of imbalances. Again, you can see the buildup of imbalances, but when nobody worries about them, what are you going to do? Some things that are newer is focusing on, and that came out of this crisis, focusing on the network effect, focusing on the exposure of key players, the lack of diversity for the system as a whole. And of course, we can do some stress testing, which are being increasingly done. Now, the problem with stress testing is that the risk that really bites you is the one you haven't tested for, the one because you haven't seen it coming. So what is being done to reduce vulnerabilities? Well, there's a lot of ongoing work internationally in various forums, in the G20, in the FSB, the Basel Committee, the CGFS that we mentioned this morning, other Basel committees. And some of the most promising work from our point of view, my point of view, is the work on improving market infrastructure. Anything that can provide certainty to markets, and that's improving market infrastructure in terms of central counterparties in terms of continuously functioning open core funding market, procedure for orderly resolution of financial institutions that are in trouble, and if we want to kind of reduce the risk of too big to fail, it is important to have a clear resolution processes that's clear to market, that is credible. And all of these, in a sense, provide some certainty that if something happens, if an institution fails or a participant fails, people know how the losses will be allocated, and then they can price this risk, the risk that they see. Another important issue is reducing procyclicality, and we've been talking about countercyclical capital requirement, talking about through the cycle margin requirement, and of course, so all that increases and the other element is to increase the robustness of the institutions themselves to shocks through higher capital, higher liquidity standards. Now, some of the talk are about surcharges on capital. I think that's, or in some sense, it's trying to use the capital charges to target specific imbalances, and I think that probably, I mean, those are the parts that are extremely iffy in my view. The fact is that we tend to forget, because we've been in a crisis where their credit markets have been impaired, we tend to forget that in good times, in normal times, money is very fungible, and there is always ways for money to find its way and go around restriction. So the challenges that we see as that are important are understanding transmission channels, getting data on the interconnectedness. There is, but on the other hand, I mean, if we get too much data on interconnectedness, what would we do with it after we know what it is? That's a question that is left unanswered. I guess I'll skip that for short of time. One of the questions that was put is Macro-Prudential policy a third stabilization policy? Now, maybe after we've developed the framework completely, it will help, but at the moment, sir, I don't think so. Stabilization potential is certainly a side benefit, and we have said that in terms of monetary policy, given its limitation, maybe the first line of defense on stabilization, on financial stability is Macro-Prudential, but the real objective of Macro-Prudential is to strengthen the resilience of the financial system to shocks, not to stabilize the macroeconomy, which is more the role of monetary policy. At the bank, we are working on some of these issues. We're developing a risk assessment framework, some macro stress testing technology, clearly modeling real financial linkages, which is the toughest part. In Canada, just to end here, because we do have, I mean, in terms of the coordination, we are lucky in a sense. One of the source of our strength is that we do have very effective coordination among the federal regulatory agencies, and we have complementary mandates for the agencies that started in 1987 after a small the collapse of two small banks. We created FISC as part of legislation, where FISC, the Financial Institution Supervisory Committee, includes the heads of all the agencies, the supervisor, the central bank, the Department of Finance, the CDIC, the Deposit Insurer, and the Financial Consumer Agency of Canada, each with a clear mandate and compatible mandate. And all of these same heads are also forming the Senior Advisory Committee, which is basically advising the government on the development of financial sector policy in Canada, policy that has to be renewed every 5 years. So we've had, at the time the crisis occurred, we had 20 years of working together very, very effectively. That's a big plus compared, for example, to the UK system where there's tension between the FSA and the Bank of England. We had been working together, exchanging information, and in fact, the FISC requires the exchange of information. That's for Macro-Prudential, obviously. We have to widen that to take a more Macro-Prudential view, but clearly the macro view is brought under discussion at by the bank. Another source of strength, and I'm ending that, is that we do have, although we haven't had to use it, we do have some relatively clear resolution mechanism, or at least early warning, early intervention. We have legislation, FERP legislation. We will have Bridge Bank, and both the CDIC and OSFI can take over an institution, and that's relatively well known. So I'll stop here because I am out of time.
Right. Thank you very much, Pierre. Questions?
In my mind, what we've experienced in this meltdown is a governance crisis, right? When we're developing these robust models that will help us to predict the next crisis. But I think what we want to develop is a model that will help us avoid the next crisis. If we can predict a crisis and then it hits us 3 months later, we're not really a lot better off. So my question, I guess, comes down to, in the context of governance, who regulates the regulators? How do we know the regulators are doing their job, right? If the Fed had done its job, if the SEC had done its job, we probably wouldn't be here today. The world would probably be a better place. And the question is perhaps more profound than that, is we can develop all the rules that we want to avoid a systemic crisis. But if the values of the guy who's running the system is such that he or she doesn't believe in the rules for the system, then you're going to have a failure. So if you're a strong believer in markets, and that markets can do no wrong, or if they do wrong, they will self-correct, you're going to regulate in that fashion. And so there's a need to get a handle on the regulators. Now, I guess the obvious solution is the elected officials ought to be doing their job. But they suffer from what Philip calls asymmetric information, right? They don't know what's going on. So they're captured either by the industry or by the bureaucrats who claim they know what's going on. So I kind of put that comment and question to everyone. I think to consider is how do we regulate the regulators to get the output that we want? But we don't want models to predict crisis. We want models to predict the avoidance of crisis.
Philip, do you want to respond to that?
Don't laugh, you will get the perfect solution now. No, obviously, answered scientifically, in any agency problem, you have multiple layers, right? So if you have a principal and an agent, then of course the principal, in some way you also need a principal to monitor the principal. So I think this is a common phenomenon in all types of activities. It's a problem for firms, it's a problem for governments, for policy authorities. So this is always an issue. So, I mean, if you take the Systemic Risk Board, there would be the mechanisms, for example, would be that, first of all, if there are public warnings or public policy recommendations, of course, there would be subject to scrutiny from any party that looks at this, from the press up to financial system expert, I mean, market participants, up to other policymakers. One aspect. The other aspect, of course, the chairman of the board would have to report to the European Parliament and would have to be accountable towards the policies done by this body with respect to the mandate it has. Of course, you already preempted that type of answer by saying, well, there's also incentive problems in the political sector, but at some point you have to stop. I mean, otherwise you stop with God, and I'm not sure you have a good principle for God. So this is a problem. I mean, the known and relevant in the European setup, the known and relevant mechanisms to control the new macro-prudential supervisor would be there. The public scrutiny and the reporting to the parliaments, for example, that would be there. In terms of how to, do we have a model to fight the crisis? I think the list of policies that I had, policy measures or instruments, was exactly designed for that fact. But if you mean model more scientifically, I fully agree with you. We're lacking a model, a proper analytical model to assess macro-prudential regulatory policies. So that was actually the motivation for one question I asked in the fiscal discussion we had, was that I'm a firm believer we need to develop a different type of aggregate framework to assess financial instability in a macroeconomic context, and we are no way close. I mean, Charles Goodhart sitting here has made some advances with various courses in this direction, but we are way far to have such frameworks and rely a lot on experience and judgment in that regard.
Pierre, do you want to respond, or?
Well, I think that was a very good response. I mean, indeed, the who regulates the regulator, in a sense, it is the accountability of the regulator to Parliament or to the elected officials. But yes, I mean, the regulators will make mistakes too. The biggest danger is that of intellectual capture, and certainly within regulators, one can try to have more diversity of opinion. I mean, I've talked in terms of kind of portfolio diversification and diversity, but diversity of opinion is also important. But in sense, ultimately, I think you will not change human nature. So the role of some structural changes here, and some of the structural changes that are being talked about are not about when to intervene, but some are changing the infrastructure to increase predictability, to increase certainty, which should help. And the issue here is to strengthen the resilience of the financial system. It's more important to strengthen the resilience of the financial system to a shock, to a crisis, than to prevent the crisis. Because human nature being what it is, I don't think you'll ever prevent crises. What you can do is minimize their consequences for the real economy and for the financial system, and that's what some of the infrastructure changes that we're talking about are meant to provide.
Tiff, did you want to ask a question or respond to the previous question?
Actually, I wanted to build on Philip and Pierre's response to the previous question.
We should get you to, even though you've done it before, say your name again.
Sorry, Tiff Macklem. I think another element to answer the question is international assessment and peer review. I agree with everything Pierre and Philip said. I think what we've learned from this crisis is we've got to strengthen the standards, the rules. We've all got to actually implement these on the ground in our countries on an effective basis. And then the third piece is we've got to open up our systems to international assessment and peer review. And there is a lot of work going on this as the Financial Stability Forum's membership was expanded to include all the G20 members. It also includes a few other countries like the Netherlands, Switzerland, Hong Kong, that have important financial centers. And it was renamed the Financial Stability Board as part of that and given a firmer mandate and foundation. And part of the conditions of membership of the Financial Stability Board is everybody has agreed to undergo an IMF financial sector assessment program roughly every 5 years, so that the IMF comes in. It's a very intense exercise. Canada's done a couple of these. We found them very helpful, but not all countries have, and I think these will be done. They will also be published, so there is a certain level of transparency which will lead to international peer pressure. To complement the IMF exercise through the Financial Stability Board, there is a system of peer review which is being set up. This is a bit of a advertisement because I actually chair the FSB's Standing Committee on Standards Implementation, and we are putting in place a system of peer review for FSB members, and there are two kinds of peer reviews: country peer reviews that look at the application of the core standards in the countries, the FSB member countries, and thematic peer reviews that pick a particular topic and look at the implementation across the whole FSB. We've done our first one on compensation, the application of the FSB's compensation principles. And in addition to that, there's an element to reach out to all jurisdictions and ensure that at least for certain minimum standards with respect to information exchange, all jurisdictions will meet certain standards. Now, you're right, these are not, these financial regulations, they're not WTO binding type legal restrictions, and every country is going to have to decide at the end of the day. But the idea is, by having a rigorous system of international assessment and peer review and being transparent about these, the hope is to create a race to the top, and so that and create a system where countries really want to put a lot of effort into adhering to standards. Thanks.
Chuck?
Just a question for Philip. I was sort of looking at the proposed EU supervisory structure, and two related questions came up. If I'm reading it correctly, the European Systemic Risk Board is going to have, I don't know, 20, 25 members? Maybe I'm reading this incorrectly, Philip, but it looks like a very large number of people, and I worry a bit about committees get that large, how functional they are, how well they can function. And you might want to comment on that. The second one is the relationship between the Systemic Risk Board and the European System of Financial Supervisors. One of the things that Pierre mentioned was the existence of FISC, which has stood us in very good stead. When Clyde Goodlett and I wrote a piece for C.D. Howe a couple of years ago, we also footnoted the fact that another example of what is clearly a good arrangement is the Memorandum of Understanding in the United Kingdom, which on paper, by the way, looked very good. I'm sure Charles will correct me if I get this wrong, but my understanding of what went wrong there is that they didn't really meet in peacetime, i.e. when there wasn't a crisis, and a committee that doesn't meet in peacetime can't deal with a wartime issue very easily. Right. So now again, as I say, that's my reading of it from the distance. But I was just also wondering whether there's been arrangements made in terms of the nature of meetings, how frequently, and what sorts of things will be discussed and so on. It may be early days for that, but I was just wondering if progress has been made on that.
So starting with the second question, so I hear, and what I hear is about the functioning of a FISC is a very positive experience of a committee functioning for financial stability purposes. Now we should, however, also consider that it's limited, I think, to financial institutions. So it doesn't include the financial markets and maybe other things. So it is also a less complex activity, and from the angle of the scope of that committee, and it is also, of course, much more easy to do that at the level of a country than at the level of a union of countries. And that brings me to the non-answer to the first question, which is that obviously, I mean, the large number of membership has to do with a large number of EU member countries. Otherwise, it's pretty concise. Other bodies are only 4, apart from the central banks in each country. Now, that is for the moment in the current proposal is like that. This body is starting, so there is no type of, at this point, I haven't seen any proposal that related to some type of rotation or so of presence. So this committee will have to deal with this number of members. So a strong chairman is called for, and a good steering committee, and a good agenda setting. But of course, the dynamics of the discussions will have to be managed in relationship to this type of composition, which we can't change at this stage, at the start of this exercise. I wanted to make one remark about what Tiff said. I wanted to add one thing. So I thank you very much for referring to the IMF-FSB peer review, which is very welcome to mention it in this context. I wanted to add one thing for a general governance of supervisory authorities. I have no panacea how to do that, but I truly think we have a very, very fundamental problem with respect to financial supervision and regulation, which is that for those who exercise this task, there are hardly any benefit, prestige, or positive remuneration, or whatever you want, for being successful in doing that. And there's a terrible downside of very rare financial crisis where a lot of blame and burden is put on this. So part of this problem of peer review we might solve if in some form or another in the governance of this institution we create an upside, a remuneration, a publicity about success. And the success is when everything is normal. And it should be a recognized success and should be in some form publicly or in other form be mentioned or communicated so that the public and other responsible people actually feel and see the success of that activity. I do think this would be helpful in going some way also in the direction of accountability and success and dealing with imperfections of other mechanisms of peer review.
Ian Lee from Carleton University, and the question's for Dr. Hartman. This is possibly a restatement of the first question, I'm not certain. Is it possible that the macro-prudential framework you are developing in Europe is in fact potentially introducing risk that you are trying to keep out? And I want to give you two examples of what I mean, one at the micro and one at the macro. In the IMF Global Financial Stability Report in April of 2010, I think it's on page 10, anyone can look it up, it shows the bank losses around the world from 2008, 9, and 10. For the European Union, it was about $1 trillion expressed in US dollars, of which 700 billion was actually written off, 300 billion deferred, if I got the numbers right. And for 2010, it's another 800 billion expressed in US dollars. So and then there's the losses coming from, possibly from Greece, if there is a default and a write-down. And going into the 2008 recession, the European banks were undercapitalized and over-leveraged. Now they've taken this huge hit, and you're proposing a bank tax, which it seems to me is going to make them more vulnerable because they need to recapitalize in a very major way because they're in very bad shape. So there's the first example. It seems that one of the policy instruments you're proposing, an additional bank tax to make them stronger, is going to weaken them and possibly even tip some of them over the edge, depending on what happens in the next 6 to 12 months. And then on the macro level, the most obvious one of systemic risk is the unbelievable debt to GDP indebtedness undertaken by governments in the European Union, with the average approaching 100% debt to GDP within 2 to 3 years is forecast. Is that not the biggest systemic threat of all in your region?
Do you want to respond, Philip?
Important clarification. I tried in the part on policy instrument to illustrate the range and the nature of the policy instruments that we can consider in the context of macro-prudential supervision and regulation. I did not propose any of these measures. I tried to provide an overview and illustrate what we are talking about, since it's a relatively new policy area. Macro-prudential regulation is a new policy area. So I didn't certainly not at least in this talk, propose any of these measures, including I did not propose the bank tax. So that was a misunderstanding, truly. And on the second question, I actually said, I believe, that I think my words were as follows. We painfully experienced in the recent times that fiscal developments can be a relevant risk factor. And that, I think, was meant to be capturing your point. And I think that the macro-prudential body, which would not be a fiscal authority in the European context, the supporting institution would be the European Central Bank, and then the members would be the central banks plus the 3 supervisors plus the European Commission, which is not a fiscal authority, or the central fiscal budget is very small in Europe. Actually, this body would be relatively remote and would have a lot of independence concentrated in the body with respect to fiscal authorities. So from the angle of your concern, which I think is a fully valid and justified concern, I think the setup is actually not bad.
John Sloan. I'd like to make an observation for which there's probably no easy answer. I was struck by the tools that are going to be available to the European Financial Risk Board. At the end of the day, it pretty well boils down to the possibility of going public. And I guess what struck me is in a sense, you're recreating, I think, the challenges for the Financial Stability Forum, somewhat improved with the Financial Stability Board, and also the FSAP process. You create an analytical ability to identify the risk, but then basically you can't do anything about it. And the question is, when you've identified the vulnerability or the systemic risk, what is the European Financial Risk Board actually going to be able to do about it?
You seem to be the beneficiary of most of the questions, Phil. Go ahead.
When it becomes more difficult, I pass over to Pierre. Okay? So I had a slide where I tried to address the issue, what happens if the body that is in charge of the surveillance doesn't itself have the instruments or all the instruments, and I tried to pen out a number of mechanisms that are meant to deal with that problem. So you should, however, compare to the alternative. The alternative would be, since most known regulatory instruments are at present in the realm of the Macro-Prudential supervisors, which are with a formally different mandate, you would have to transfer all this competence and all this competence for this instrument to a new body in a policy that is actually a relatively new policy. So the question is, so either you have the issue that you have to make the recommendations bite, and I had a slide on discussing how you can make them bite, or you would have to transfer most of this toolkit actually to a new body that, as was pointed out, I think by Pierre, is untested, a relatively new policy with new objectives. And the question is that a better solution? I'm not sure. It's drastic, it's very drastic to do that in the first step. We may want to contemplate that, we may want to discuss more about it, but it's a very courageous move to move all the Macro-Prudential regulatory instruments to a new Macro-Prudential body. The first step in the right direction could be to have this surveillance authority with the competencies that I illustrated and work on the pressure that it exerts in these recommendations actually being implemented. And I was discussing, for example, the comply or explain and the potential of publicity. So comply and the body could communicate about what was the effect of a certain measure not being implemented. And there can be a good dialogue. I mean, policy authorities will not want to discuss that together in public. There will be a dialogue and there will be conclusions from this dialogue between these bodies. It must be an experience of the FISC, actually. Then, if that possibility exists, actually, the things are taken seriously. So we really have to think about the alternative. And it's not clear the alternative would be better at that juncture where we are.
Hi, Kim McPhail. I'm wondering, in looking at this, there's quite a set of instruments and some objectives and tools and so on. And I'm just thinking about how, I guess we heard this morning, maybe it was from Bob, that in most of our models of the economy, we don't even have financial sectors in them. And so really there's a real challenge there in that we can put together some indicators and stuff like that, but we don't really have even good models, theoretical. And there's an awful lot of model uncertainty out there. And I guess in looking at this, my question is really how, in that context, I think you talked about the role of kind of judgment and that kind of thing. What is your vision for how all of this fits together in terms of what would feed into the policy process, the mix of kind of modeling, the mix of indicators, the mix of judgment, and how would that all kind of fit together? And what's your vision for that?
Okay, I can. Well, I can start if you want. I mean, you're quite right. We don't have, I mean, in most of our macro models, we don't have a financial sector. We have an interest rate rule for monetary policy, and that's about it. Now, there certainly is work going on in terms of building, and on my side, I had the work that we're trying to do, building real financial linkages, so building kind of the essence of the financial sector into a macro model. I mean, the existing macro model in normal times has served us reasonably well, but of course in crisis time, when the financial sector becomes important, it doesn't. But as you know from your own experience, we've been trying to build financial sector models before, but they never went very far. But we're working on a number of new approaches, introducing bank capital in models. There is a kind of a financial accelerator modeling work that's going on. We're trying to build up a kind of an interbank market in models that at least capture it, because I mean, one of the things that happened in this crisis, of course, is that interbank market, or the money market, seized. So we are trying to build these models. It's still early day, difficult to see how successful that would be. We're certainly going to to use some of these models to look at the macroeconomic implications when we do the impact study of higher capital requirement, higher liquidity requirements, for example. So there is work going on. It's but we will have to make a decision clearly well before we have the outcome of all of these models. But that's always been the case.
Just one addition to this very comprehensive answer is that I tell you, I'm of the proponents of these changes in the frameworks we have, and I face major difficulties. And I tell you, one major difficulty I face is that and I myself come from a research background, but we have to face it. There's enormous resistance in the academic macroeconomic community to change paradigm or to add a paradigm. It is awfully difficult for a central bank-based person to come along and say, listen, we work on it, but we don't have really the fully satisfactory tools available. And of course, if the major part of the academic community is thinking, well, it's better for me to work on the existing workhorse and not extend it to something very decisively extended, we are lost. We also rely really on the academic sector innovating in that regard. And I think that it's high time to change macroeconomics in that regard, not to throw away what we have already, but to add something that is going more seriously in that direction.
We have time maybe for two brief questions. Go ahead.
Don Cohn. I was wondering, would like to hear Philip and Pierre ruminate a little bit on this early warnings thing. It seems to me that looking at this chart, this particular indicator was terrible. It predicted that the dot-com bust would be far worse than what we're going through now. And in fact, it didn't really give an early warning. I'm using the 70% line. Didn't really give it, like in June of '07, it gave an early warning that something would happen in August. And I think that it's just really hard. And we're going to get a lot of these type 1 errors, aren't we? So the point you made before, Philip, I think, about the penalty will be for people not making warnings. And we're going to get a lot of those warnings. And Pierre and I serve on an early warning, in an early warning exercise. And I don't know your reaction, Pierre, but I think we talk a lot about really obvious kinds of things rather than, things out in the tail. So and maybe the answer, as you said, Pierre, is just build a resilient system so that even though we as human beings will never see the problem coming, the system will be more resilient to it. But there's a cost there too. I mean, if we require banks to hold capital and liquidity against 100% of all the distribution, that'll have an effect on growth. So this is kind of a negative, I realize, a negative slant, but I do wonder whether we'll how much progress, I'd like to hear you guys talk about how much progress you think we can make on in the early warning exercise.
Well, I'll start on that and give you a little time to think about your answer. In fact, I had kind of the same reaction when I saw that chart. I mean, it is difficult to get early warnings. As I said in my presentation, one common occurrences of these crises that we do see excessive or what exposed is called excessive credit growth. So I think it's focusing on credit growth is probably the right variable. Of course, private credit to GDP would miss public sector crises. That's a different point. No, I think that illustrates the fact that there's still a lot that we don't know in terms of how imbalances are built up. The thing we are clear about is that there is a lot of credit growth associated with it, and if there is a bubble in stock market that's for example that is not credit finance, when it bursts, the consequences for the economy, for the financial system, are much less severe. That's been observed that it's really boils down to credit growth, the exposure that are built up. So from that perspective, I think it makes sense to focus on credit growth as early warning. In fact, one of the things that we are proposing in Canada on the Basel Committee is to have pro-cyclical capital requirements based on the credit cycle, the same indicator as here, the credit to the deviation of credit to GDP from trend, as opposed to linking it to the real cycle, real business cycle, for example, or other market prices. So I have sympathy with this measure, but again, it is not a panacea. So I certainly do share your reaction.
I'll just interrupt to say we're running a little short of time, so we'll have to keep both the question and the answer quite brief.
Well, a couple of brief comments and the question. The first very brief comment is, think how difficult it would be to run monetary policy in an inflation targetary system if you couldn't measure inflation. All you had was hyperinflation and the rest. And that's more or less where we are. So the importance of measuring financial stability is, if you're trying to get accountability, is I think hugely important. Next quick comment is a certain amount has been said about the tripartite committee in the UK of the FSA, the bank, and the Treasury. And I think there's a lot of misapprehension about that. It actually worked perfectly well. It met very frequently in peacetime. The problem was not so much the existence of the committee. In fact, you have to have a committee of that kind to combine micro-prudential, macro, and fiscal resolution. The difficulty was that everyone was so keen to avoid forbearance and moral hazard that everybody had a veto, everybody. And when it came to Northern Rock, Mervyn King was very concerned about moral hazard and wanted not to save Northern Rock, while the FSA and the Treasury wanted to save it. And the problem was that there wasn't a clear allocation of who was in charge. And the great question at all the subsequent hearings was, who was in charge? Now, my question for Pierre is, when you have your senior advisory committee and your financial institution supervisory committee, when there's a division of viewpoint about what to do, is there a clear person, is there a clear institution which is always in charge? How do you deal with disagreements within these committees?
Okay, quickly, well, the FISC, it's not so much SAC. SAC is the advisor on policy, but FISC, which makes the decision, or the execution committee, is chaired by the superintendent. It is there, obviously, I mean, to provide information to the superintendent or ask information from the superintendent. The decision in the end would be, I mean, the decision to close an institution or to support it would be the superintendent's decision. The deposit insurer who may have to pay up the cost in the end also has the power to take over an institution with the approval of the minister. The bank's decision is really about extending ELA, but if the superintendent says the institution is viable, I mean, yeah, if the bank strongly felt the institution isn't, it is not forced to do ELA, but then de facto that would terminate the institution unless the CDIC could also, the deposit insurer can also extend loans to an institution.